Okay, thank you for that. And I think I'm going to steer clear of the latest EIOPA paper, given the 40 minutes that we have. Sustainable finance and sustainable insurance in particular, and I think as we sort of take a step back and we move away from things like Brexit, and we look at the big kind of existential issues that are facing us, us ourselves and our children and our children's children, it really is around sustainability, that whole agenda and the pace of change. The Paris Agreement, the United Nations Sustainable Goals for 2030, the extent to which there's so much for us to do, and in many respects, as Greta Thunberg would have been saying at the UN summit in New York a week or two ago, the pace of change just isn't quick enough. How dare you sort of fiddle around the edges rather than getting into the heart of the issue with so little time. As was, it echoes comments that were made earlier today, so much that the insurance community can do, as risk managers on the two sides of the balance sheet, so from an investment management perspective, from an underwriting point of view. So hopefully some useful, pearls of wisdom to take away today with our panel, and we really have a great panel. I'm very pleased that we're joined by Butch. Butch Bacani leads the UN Environment, the Principles for Sustainable Insurance Initiative, so not just sustainable finance, but specifically in the insurance space, working with industry within the UN. And then we have Zelda Bentham, who is a group head of sustainability within Aviva PLC, so looking at it from a big insurance group going back more than 300 years of pedigree and history. So there's a real sustainability there in terms of looking back, but let's look forward. And then Jan Lepalak, who is an executive managing director with Standard & Poor's, with S&P, and who's grappling with issues around ESG, environmental, social and governance in terms of the credit rating function, but also as you kind of build in the more, I suppose, ephemeral aspects around sustainability. So a great panel, and looking forward to hearing observations. We thought we might start with maybe a sort of a 2 or 3 minute segment from each of our panelists. What is ESG as far as they're concerned in their organisation, as you look particularly at sustainability principles in the context of insurance. I felt no better place to start than my immediate right, Butch. So Butch, maybe turning to you and an opening statement from you if we could.
Thanks, Owen. First of all, I'd like to thank Insurance Ireland for the invitation. The title of the conference is perfect because it's aligned with the overarching horizon of the UN Sustainable Development Goals that were forged in 2015 by the world's governments. So these are 17 goals that will cover poverty alleviation, resilient cities, climate action, life below water, life on land, etc. Basically, if you summarize it, it's prosperity for all on a healthy planet. And that is the global agenda for sustainable development. And that's the reason why the UN is very active in this space, is because ultimately the UN is concerned about sustainable development. Now, sustainable development has 3 interlocking and mutually reinforcing dimensions: an economic dimension, a social dimension, and an environmental dimension. Those 3 parts should all be sustainable. Otherwise, we won't reach sustainable development. And the reason why the UN is interested with the financial sector is because in order to achieve sustainable development, we know that we have to have an economy that will support a healthy environment and promote social equity and respect human rights. And that economy is underpinned by the financial system. And that financial system is underpinned by banks, insurers, and investors. And that's the reason why the UN has an initiative with the global insurance industry. And so in the context of sustainable development, we believe that the insurance industry has a very critical role in supporting sustainable development. So through its triple role as a risk manager, an insurer, and as an investor. As a risk manager, we believe that the insurance industry has a skill set that it could be widely deployed and used by governments and business. For example, on catastrophe risk modeling. This is something that the industry has been developing over the last few decades and can be improved in the context of issues like climate change. However, so understanding risk in order to be able to prevent and reduce losses is the bedrock of insurance. And we believe that's the first important contribution that the insurance industry can make. The second important contribution is the role of an insurer. So obviously, this is what the insurance industry is known for, financial shock absorber when things go wrong, whether it's life or non-life. But increasingly, it's also to de-risk the transition to a sustainable economy. So as we move from a high carbon to a low carbon economy, how can insurance solutions de-risk that transition and facilitate that transition? And also the role of an institutional investor. Globally, the insurance industry has over 30 trillion in assets under management. So the way that capital is deployed and invested would have a telling impact on sustainable development. So it becomes then pretty clear on why the insurance industry is important. And this is the reason why in 2012, the UN, together with the world's insurers, launched the Principles for Sustainable Insurance, fittingly at the 20th anniversary of the 1992 Earth Summit in Brazil. So that was 2012. And we believe that was an important moment in time to show leadership by insurers in the context of sustainable development. So these principles were developed in several years with insurers around the world. In Europe, the consultation was hosted by Munich Re in Germany, and we went to 7 regions around the world. So these principles are something that is supposed to be universal. The principles are based on the spheres of influence of an insurance company. They cover environmental, social, and governance issues. This is a jargon that the UN created in 2004 when we were working with financial institutions and investment managers, because what we realized is that issues like climate change, human rights, were not routinely embedded into financial decision-making across lending, insurance, and investment. And sustainability could mean different things to different people. So we tried to understand what are these elements of sustainable finance that are of finance that have to be sustainable, that have to be routinely covered. So E, S, and G were framed to cover, to better understand environmental issues like climate change, biodiversity loss, ecosystem degradation, social issues like human rights violations, financial inclusion, and governance issues like bribery and corruption and transparency. So in this context, the term ESG evolved for institutional investment, and then we applied it also into the insurance business. So the 4 principles for sustainable insurance cover, principle 1 is about embedding ESG or sustainability issues into core business activities. How you set your company strategy, your underwriting guidelines, your investment management, your claims management. How are sustainability issues embedded into all of those core business activities? Principle 2 is about the insurance industry value chain. If you're an insurer, it shouldn't end with you. It should also be applied by reinsurers, by intermediaries like agents and brokers, as well as clients and suppliers. And principle 3 is about embedding sustainability in your work with governments and regulators and other key stakeholders like civil society. So this is the reason why the UN is particularly interested, because it's an intergovernmental platform. This is the reason why we believe financial regulators and central banks and insurance regulators are a core part of the agenda, and we heard them earlier today. And this is the reason why civil society is also important. And finally, principle 4 is about accountability and transparency. Everything commitments by insurers have to also be made accountable and transparent to key stakeholders, whether it's policyholders, regulators, or governments. So that is, gives a bit of an insight into why we develop these principles. I can tell more later, Owen, on what we're doing collaboratively with insurers.
Okay. Thank you, Butch, for that. I think that sets the scene very nicely for us, and the initiative at a UN level. And I wasn't aware of the fact that the ESG concept actually is a United Nations initiative. I suppose, Zelda, maybe just initial observations, maybe particularly around the first of the principles, the whole idea of embedding ESG and sustainability within a group, and a group of such complexity as Aviva. You're laughing already.
Yes, you're right. Aviva is pretty complex. And I think it's down to our 300 years of history that you mentioned before. But still, it doesn't matter how big or how small an insurance company is. There is still stuff that we can do in terms of sustainable finance. Our CEO, Maurice Tulloch, was at the UN General Assembly and Climate Week in New York last week. And he talked about an uninsurable planet being, you'd mess it up. An unsustainable planet equals an uninsurable planet. We need to have some certainty there in terms of being able to provide insurance. And the issues that face us today, whether it's climate change, whether it's inequality, or different emerging issues on a non-financial basis that are coming to the fore, is really focusing the mind of Aviva. However, we recognise this nearly 3 decades ago when we became a founding member of the UN Environment Programme statement from insurance on environment back in 1995. That statement actually just didn't cover insurance. It was more, didn't cover environment. It was more looking at the human implications of it, not just the physical implications of it. In 2001, we became a founding signatory of the CDP and have responded to that ever since. And we've been pushing for non-financial considerations to be included at a macro level, whether it's policymakers and regulators, all the way through to how we get our customers to understand and start mandating these kind of considerations in their investment decision making. Using the ESG, the environmental, social and governance framework, to make investment and business decisions, we don't see it as warm and fluffy or a nice thing to do if we have time. It provides additional far-sighted view of the value of our holdings. We have 4 values at Aviva, 4 corporate values. The first one is care more. The second one is never rest. The third one is kill complexity. And the fourth one is create legacy. And all my colleagues at Aviva know and stand by these values, both from a customer point of view, but also looking at what impact that has on the planet. Care more, never rest, kill complexity, and create legacy. And the reason why we integrate environmental and social and governance considerations into our investments and how we try and do it for our customers as well is because our customers' welfare isn't only determined by the size of their savings, but also by the state of the future of the world that they're going to retire into. We've seen a lot of evidence that customers actually want this, but don't particularly know how to do it, and don't relate it necessarily to their savings and investments. They will take it to purchases, fair trade labels, for example, the everyday commodities. But we need to start educating our customers to make sure that they take it into consideration when they're making those big financial decisions in life. That's part of the work that we're doing at the moment, but you can go on.
Okay, thanks, Zelda. And again, I suppose killing complexity clearly is a big part of it, and again, the interconnectivity of all these things, which is something Butch was touching upon earlier as well. Jan, then the angle from S&P's perspective, from I suppose traditionally what you'd call a credit rating agency, but the extent to which actually you're morphing into something different when it comes to ESG. It's not just sort of a pure assessment of credit risk. It's something much deeper. So I suppose initial observations may be around the new role of the credit rating agency within the ESG world.
All right, so first of all, thank you very much for inviting me. Coming to Ireland, and specifically Dublin, is always like visiting the family. My family actually crossed the channel around 800, that was yesterday, to settle in Brittany in Western France, and they stayed there up until the Second World War. That was sustainable. So always delighted to be here. Are we changing into something else than a rating agency? I don't think so. But I believe that ESG considerations now are right front and center, whoever we talk to. So if you look at the constituencies that we serve primarily, you've got the investors, and when we rate insurers and reinsurers, you would have the intermediaries, and finally the policyholders. With investors, we engage day in, day out. I can tell you that in this region, but globally, there's not a single meeting with an investor where ESG is not part of the debate, and usually the conversation these days starts with ESG. What are you doing? Can you provide us with more information? As investors, all the people we talk to think they have to do something. So this is driven by two things. Primarily in Europe, there's a strong regulatory and political push for sustainable finance. And let's say that across financial services, apart from the very large players, the rest of the asset management, the banking, the insurance industries are in a catch-up mode. And that's what is triggering that level of interest and concern in certain quarters about getting the right information so that those investors can demonstrate that they carry out the right due diligence in terms of sustainable investment. The second and much more structural push is actually coming from the end consumer, and Zelda touched upon this previously. It may not be obvious to people in property casualty that this could be a concern for the policyholder, for the ultimate client. But in life insurance, particularly as you move closer to annuities, pension-type products, if you look at markets like Scandinavia, the Netherlands, for a long time, consumers have asked pension funds, life insurers, to guarantee that their money would be invested in a sustainable fashion, complying with sustainable finance standards, or ESG would comply with ESG requirements. And that long-term trend is actually rising. And it is something that is coming in more and more into Southern Europe in particular. So we do think that, number one, there's a fundamental and structural shift that is driven, again, by the end consumer. And that second, because we're being asked to provide more information, more data, more analytics, more insights, that we've got a role to play. And that role is in two key dimensions. We remain, and we are, a credit rating agency. Regulation is moving on in Europe. We have to indicate very clearly when any of the ESG factors has had an impact on credit ratings. And this is something that we've started to roll out at the beginning of this year, writing more clear paragraphs in all our communications on the oil and gas industries, metals and mining, and we will roll this out across every single sector by the end of the year, including insurance, by the way. So we will provide more disclosure and we will be more transparent about to which extent ESG risks have had a role in our credit ratings. And they do. If you take the three pieces, E, S, and G, G is in every single of our methodologies one of the key chapters. Where it becomes more difficult to understand is E, that is very sector specific. And S, as you know, is probably the risk that is the most ill-defined and that does not always have a real credit impact. But we are publishing a lot on that and we are bringing forward proposals to the market according to those risks that we consider are part and parcel about how social exposure should be assessed.
Okay.
So we do spend a lot of time on research. And more recently, what we've done is that the second prong of our approach is to launch. Last April, we did launch what we call ESG Evaluation, which is an assessment that looks at the totality of ESG risks for a particular entity and not specifically what is credit relevant, but the totality of ESG risks.
Yeah. Okay, thank you, Jan. And I suppose picking up on one of the things that you were saying there is just so much of this is actually consumer driven, you know, from I suppose the Nordics or certain countries sort of leading the pack and others following. But the way that industry has kind of got in behind it and Butch, correct me in terms of my numbers, but 25% of worldwide premium in terms, 15 of the 16 largest insurers, just however many trillion in terms of the assets of the different groups that are involved working with the UN now on the principles for sustainable insurance. So there's good traction with the industry, but clearly a lot more to do.
Yes. So I think just to give the context, I think for one of the most important things to realize in the sustainability agenda is science. So if we look at science, what it's telling us, last year the Intergovernmental Panel on Climate Change issued a special report on 1.5 degrees. It showed that the difference between 1.5 degree world and the 2 degree world is a world of a difference in terms of economic, social, and environmental losses, be it on sea level rise, extreme heat, loss of ecosystems, fisheries, coral reefs, etc. So when Christiana Figueres, who was one of the main architects of the Paris Agreement, was with us in Munich earlier this year, she told us that had we known the science today in 2015, the Paris Agreement would have looked quite different because every degree of warming has a lot of negative consequences. So we are already at 1 degree and the trajectory is over 3 degrees where we stand right now. And just to give an example, at 1.5 degrees, the best scenario we're hoping for, we are expected to lose 70 to 90% of coral reefs. At 2 degrees, it's virtually all gone. That is what we're facing right now in the context of scientific and ecosystem issues. The UN report on biodiversity and ecosystems a few months ago also said that in the next few years and decades, we will lose 1 million plant and animal species. They will go extinct if we go the way development is going right now. And just over a week ago, the IPCC issued a special report on the ocean and cryosphere and the state of play. And it's not looking good in terms of the oceans getting more acidic and warming, and ecosystems being affected and cultures being affected. So I think using science in decision making is important. This is not about religion. This is about Science is like the law of gravity, just like we know that the high tide and low tide is because of the moon's gravitational pull. So, and science is amoral. It's not concerned with the rightness or wrongness of something. And so this is what I think what we should put at the center of decision making right now, what science is telling us and what we need to do. And what we're doing right now is falling short big time on where we need to be.
Okay.
I think that's one of the things that's really important. So from a UN perspective, we believe that collaboration is absolutely important. This is why whatever Aviva is doing and AXA is doing, if they're the only ones who are doing it, we're not going to make it. So it has to be multiplied. There has to be strength in numbers. And even if the entire insurance industry does it, it's not going to be enough. The banks have to do it. The rest of the investment industry have to be part of it. And so is wider society. So there's something for everyone. But there's something very influential with the financial sector in the insurance industry that is very critical in the eyes of the UN. So this is why we're here.
Yeah, okay. I have a question on the iPad here, which I suppose maybe you've already just answered that now, Butch, in what you've said. Are the requirements of transition so pressing that they cannot be resolved through the trickle-down effect of customer behaviour rather than direct policy intervention? So I suppose, is it possible just through customer and policyholder decisions as to where they place their business, that in its own way can solve the problem? I think the answer probably is it's much more serious than that. Zelda?
Yes, I completely agree. It is more serious than that. The challenge that we have as an insurance company, being not just an insurer but an asset owner, an asset manager, is that we are involved in every sector of the economy, whether it's fossil fuels or whether it's renewables. Whether it's the whole supply chain in terms of food, or in terms of polluting the atmosphere. Insurance companies, asset owners do have a sway on that and can decide what to do about it. Aviva is an active investor, and we've decided to engage with those companies that are creating carbon emissions, that are paying executives an unfair amount of pay, who aren't paying a proper, decent living wage. It's something that we can do by ourselves. It's something that we can do as a sector. Some other insurers have decided to divest from particular sectors. We don't believe that that's the right course of action, particularly in respect of companies that can transition away from unsustainable practices to sustainable practices. So, for example, take the coal industry. Coal is not a thing of the future, it's a thing of the past. But if we just divest from coal companies, somebody else will invest in them. Somebody who cares less than us for the future of the planet. So if we can engage and if we can get those companies to change their business plans going forward, to move away from coal and to move into more sustainable energies, that will be part of the solution. If we can't get them to move, our engagement has failed, and that's the point that we want to divest. But that's just one example. There are many examples. We can look at antimicrobial resistance, for example, and the food supply chain where antibiotics are pumped into livestock as a preventative form, not as a curative. Those antibiotics stay in the supply chain, And it means that by 2050, people will die more as a result of antibiotic resistance than through cancer. The World Health Organization has said that, and we've recognized that for ourselves as an investment company. So what we have done is we've engaged with those companies in the supply chain, in the food supply chain, particularly Yum, that's KFC's parent company, and McDonald's, and we've asked them to remove antibiotics from livestock. McDonald's has said that they will do that on an ongoing basis for their chicken supplies. So there are things that investors can do, that we can engage companies, that we can make things better. But if it's just Aviva doing it, we might make a little bit of a difference, but we won't make the difference that's needed. And that's where Butch and the UNPSI comes into it. Because if we do it on a collaborative basis, companies have nowhere to go, have nowhere else to be invested. So we think that collaboration is more important than individual action.
Thank you, Zelda. And I should say people should continue to send through any comments on the iPad or questions for the panel. And the piece, I suppose, I'm a lawyer, you know, and so I think about things like the regulatory underpinning or how you actually build it out. Rather than from the collaborative perspective solely, you know, just that legislatures around the world have a big job to do. And Jan, maybe a question for you around things like benchmarking, you know, the extent to which, as someone comes to make an investment decision nowadays, how easy it is to, you know, compare a green bond that's a Chinese bond versus, I suppose, Ireland has issued a couple of sovereign debt issuances now that are green. We need, don't we, a kind of a level playing pitch and greater sort of transparency and disclosure around the area, so that we can make informed investment decisions in the ESG area.
So sustainable finance is in its very, very early days. And as I mentioned before, there is a dearth of information, data analytics. Then the problem you're talking about is equally important, which is the lack of global standards and even more available disclosure that can be used by institutional investors like insurers to be making their decisions. So take, you know, the only standard that exists today, which is the recommendations made by the by the Task Force for Climate-Related Financial Disclosure under the auspices of the Financial Stability Board. Those recommendations are not applied across the board globally and consistently. So unless corporates, even, you know, whenever there is a public company, a municipality, a public entity that issues securities in the market, over time there is really a need for those issuers to be disclosing more and in a more consistent fashion, you know, following, for instance, the TCFD recommendations. But there's one conundrum, is that more disclosure is not necessarily felt as well. It could be threatening for the business model of the company, or you could be exposing confidential aspects to your strategy, particularly in terms of risk mitigation. And as Zelda said before, you take the example of the insurance industry and look at some of the responses made by the industry to the recent EIOPA request for comment that was referenced in the introduction. The insurance industry says two things, and by the way, it is the best example of some of the conundrums that big players are facing in the market, because as Zelda said, insurance is at the core and has a fundamental responsibility as a risk taker and an asset manager in sustainable finance. And what do insurers told EIOPA? We want more and more consistent disclosure from companies that we invest in. Second, well, by the way, we don't think that your idea to ask us to disclose more under the Pillar 3 is a good thing, because we may expose aspects of our risk mitigation strategy that actually should remain confidential. And that's where we are. And of course, because we're at very, very early days, basically the world of sustainable finance is shaping up under our eyes. But there has to be some push for more consistency and more disclosure. And this is where, I mentioned the regulatory push in the EU. There is no question that regulation and policymakers will have a role to play. It's not the only role. They will have to, the private sector will have to provide more information, more data, more comparisons, to your point. But there's no question that in order to get to a certain level of standardization and consistency, there will have to be further rounds of regulation or recommendations.
Okay, thanks, Jan. I'll take another question here off the iPad, and again, it's for you, Butch, and it'll probably have you chomping at the bit. We seem to have a couple of contrarians in here today. What are the margins of error around the future outlook that has been presented? Is the science fact or an approximation of what might happen?
Well, I think we are relying on the best science available right now. I mean, the IPCC is a body that was created by the world's governments, and we also rely on the precautionary principle. Like even though you don't have perfect knowledge of something, that it doesn't mean that you should delay action on that. But we are basing policy and action right now based on the best science available right now. And that's what the UN is doing.
Okay.
And I can come back on that from both sides. In terms of Aviva has published its TCFD now, its TCFD response for the last 3 years. This last year, we published our view of our climate value at risk for Aviva on both sides, the underwriting side and the asset side, and we published that based on four different scenarios: a business as usual three different scenarios: business as usual, 2 degree, and 1.5 degree, and we found that for a 1.5 degree scenario, that was the only scenario where there was a positive impact for Aviva. A 4 degree was off the charts in terms of both the transition risk and a physical risk perspective. A 2 degree was still very much on the edge of it being a negative impact to the company. So based on the science, based on the disclosure, we want to get ourselves on a trajectory of 1.5 degrees and those companies that we invest in on that same trajectory. Because we need to do something. It's the only way that we can go forward. Best possible science and disclosure.
Yeah, okay, it's quite amazing, really, I suppose, that when you look at the Paris Agreement, and it's only from a couple of years ago, and that idea of the temperature of the planet not more than 1.5 to 2 degrees above pre-industrial levels, and the fact that that's, we're already we're way behind, and that's just way out of date already, and it's still the thing we're talking about. So again, it instills the sort of sense of urgency around what we're talking about here. I'm afraid I think the clock is counting down. I've got 30 seconds, which is, and this is a topic we could talk about all day on, really. Closing remarks, unfortunately, as we have to wind it up. Maybe Butch, Zelda, Jan, just observations, thoughts, the number one thing that you think is a priority now, that what we need to do and quick?
Yes, it's going to be strength in numbers collaboration. As we speak right now, I can tell you several initiatives that the PSI is doing, the single largest collaborative exercise to pilot the climate disclosure recommendations by the insurance industry, a guide that will be released next month to protect natural and cultural World Heritage sites, which are under threat from harmful industrial activities around the world, a guide on illegal fishing, which is one of the most unsustainable practices related to the ocean, plastic pollution, the first ever global study, and how it relates to insurance and investment activities of the insurance industry. It will be launched next month at our Ocean conference in Oslo. So these are the things that we are seeing that insurers are doing, and we are starting to see changes out there in terms of even trust and reputation as far as the insurance industry is concerned.
Okay. Zelda?
For us, action. The cost of inaction far outweighs the cost of action on this. And we need to do something about it. We need to do it quickly.
Okay. And Jan?
And for us, the name of the game is education through research, through more insights, more data, as I said, so that we can convince, we're a B2B business, so we can convince more investors and more players in the capital markets to provide, sustainable finance, but also the end consumer as well, ultimately.
Yeah. Okay. All right. Well, look, thank you to each of my panelists here. It's a really riveting topic, and we could talk about it literally all day. I'd encourage people to look at Butch's, the United Nations Principles for Sustainable Insurance website. It's, just to bring some of the points that we've been discussing home to people. So Butch, Zelda, Jan, thanks again, and maybe in the traditional way we could thank our panel.